The global economy and financial markets faced numerous challenges and uncertainties during 2022. Factors such as Russia's war with Ukraine, energy supply constraints, and the ongoing impact of the pandemic contributed to economic instability and uncertainty. Inflation has and still is a major concern, with rates reaching new highs in many regions around the world. This, coupled with tight monetary policy from the US Federal Reserve and the European Central Bank, led to markets falling and uncertainty about future interest rate policy. During the fourth quarter, fears of a global recession have moderated somewhat, and markets enjoyed a strong rally, helped along further by favorable November CPI print in the US, hinting again that inflation may have passed its peak. However, this rally was short-lived, and by the end of December, markets again retreated given the hawkish undertones of the Fed and the ECB. Nonetheless, returns were positive in hard currency terms across all the major global asset classes for the quarter, apart from global bonds, which retreated by -2%. Developed market equity rose nearly 9%, while emerging market equity increased close to 10% for the quarter. In South Africa, the ever-present political uncertainty and a record 200 days of load shedding in 2022 by Eskom added to the challenges faced by investors. Despite these challenges, some sectors and assets performed well during the quarter, with listed property up 19%, resources and industrials up 16%, and financials adding nearly 13%. Overall, the JSE Cap Swix Index added 12.2% for the quarter. Despite the political uncertainty and rumors of the president's resignation following the Fala scandal, the rand was stable and even strengthened 5.7% against the US dollar in the quarter. Bonds and cash saw positive returns of 5.7% and 1.6% respectively. Commodities such as iron ore, Brent crude oil, copper, gold, platinum, and palladium also saw positive returns. In line with the market trend, the Momentum Focus Fund of Fund range delivered positive absolute returns ranging from 5% to 7.9% for the quarter, broadly in line with their strategic asset allocation benchmarks. All the underlying funds added to the positive absolute returns, apart from the Global Fixed Income Fund, which retreated by 2% in line with the broader asset class. Very pleasing as well was the fact that all the underlying funds managed to add alpha of between 10 and 230 basis points relative to their respective benchmarks over the quarter. The strongest outperformance was from the Momentum Global Equity Fund with 230 basis points, benefiting from cyclical sectors such as energy, financials, materials, and industrials, as well as regional exposure to the UK and Europe in particular. Another strong contributor was the Momentum Diversified Income Fund with outperformance of 190 basis points above the STEFI. In terms of positioning, we maintained an overweight to defensive assets over the quarter, given the general global risk-off sentiment and the ongoing economic slowdown or recession expectations. Our largest overweight position have been to local fixed interest asset classes, which continue to offer appealing value. Similarly, we have been adding to our global bond overweight position in anticipation of the eventual unwind of the Fed's interest rate hiking cycle during the later stages of 2023. Given the strength of the rand during the quarter, we also took the opportunity to introduce the long-anticipated Momentum Future Trends Fund of Funds in December of 2022. The initial exposure is still relatively small, but we will look to build on this over time. Now, the outlook for 2023 remains uncertain, and global equity markets may continue to face challenges during the year as potential for recessions and the final phases of rate tightening loom. However, there may be some relief towards the end of the year as markets start to anticipate a pivot towards lower interest rates by the Fed. Now, the combination of falling inflation and slowing economic growth, along with meaningful risk of a recession, could be supportive of the US bond market in 2023. This could re-establish the hedging benefits of government bonds in a global diversified portfolio, particularly during the potential equity drawdown periods, such as a cyclical slowdown or indeed a recession. The significant increase in bond yields in 2022 has made fixed income a viable income-providing alternative asset to equities, and made US government bonds look cheap compared to US equities. Although global property fundamentals remain solid and the asset class looks cheap against equities, its expense against fixed income assets diminishes its relative attractiveness. South African equities, however, have an attractive valuation, both within the global universe and against its history. This should stand them in good stead during potential global equity drawdowns, particularly during subsequent recoveries when global risk appetite rises. South African real bonds are attractive against their history and relative to global markets, with part of the high real yield differential due to a fiscal and country risk premium. The prospective SA real cash yield has been rising from a low level in line with policy rate increases and is now only slightly below its historical average. Although SA listed properties' operational metrics are improving, they remain worse than in the pre-COVID era. The potential for meaningful listed property returns upside from these undervalued levels needs to be weighed against some of the remaining negative fundamental factors. We have managed the funds closer to their long-term strategic benchmark over the past few months, as global risk appetite has faded. This is not a time for large bets based on idiosyncratic outcomes, and in line with our outcomes-based philosophy, we remain invested in markets in a diversified manner to allow for the best opportunity to meet our clients' long-term investment objectives in each fund. We remain focused on the risks and opportunities and will react as they become clearer. We also remain cautious regarding the timing and the path to higher offshore allocations, and any flows will be market and valuation dependent. Given the favorable foreign exchange dynamics, we have been looking to initiate gradual increases in our global exposure, where our strategic allocations does allow for this. That's all from me. Thank you for listening, and I wish you all a very successful 2023.